Today we're going to work on problem 8-3b, direct materials, direct labor, and factory overhead cost variance analysis. So the Road Gripper Tire Company manufactures automobile tires. Standard cost and actual cost for direct materials, direct labor, and factory overhead for the manufacture of 4,160 tires were as follows. And then it gives us all of our data. Instructions: determine the direct materials price variance, direct materials quantity variance, and total direct materials cost variance, the direct labor variance, rate variance, the direct labor time variance, and the total direct labor cost variance, and then the variable factory overhead controllable variance, the fixed factory overhead volume variance, and the total factory overhead cost variance. Okay, so again, we're going to use this data up here at the top to answer these questions. So letter A asks for the direct materials price variance. Now I put right on your working papers what the equation is to find the direct materials price variance. So we're going to take the actual price minus the standard price times the actual quantity. Okay, so if we look at our textbook, we're talking about direct materials. So we're looking at this first line up here at the top. And the first thing we're looking for is our actual price. And it tells us that under actual cost, our price was $6.50. And then we're going to need our standard price, which was $6.40. Okay, so our actual price was $6.50 minus our standard price of $6.40. Okay, and then we're going to multiply that times our actual quantity. So again, if we look at our textbook, it tells us 101,000 pounds. So we're going to multiply this times 101,000 pounds. Okay, so again, we're just taking the data from our textbook and plugging it into the equation. This is where our math comes in. And we get, if we subtract these two, we get 0.10 times 101,000, and we get 10,100. Okay, which is an unfavorable variance. Okay, we know it's unfavorable because, well, first, mathematically, it's a positive number. Okay, but logically, if we look at our actual price was $6.50, we had budgeted $6.40. So it already tells us, logically, that we are paying 10 cents more than we had planned to. So we know this is an unfavorable variance because we're paying more than we actually had budgeted to begin with. Okay. The next one, looking for the direct materials quantity variance. So what's the difference in the quantity of the direct materials that we used in creating, creating these tires? So we're going to take our actual quantity minus our standard quantity times our standard price. So again, back to our textbook, still looking at direct materials, our actual quantity, 101,000 pounds, minus our standard quantity, 100,000 pounds, times our standard price of $6.40. Okay, so again, just taking the numbers from our textbook and plugging them in here. Actual quantity was 101,000 minus our standard quantity of 100,000 times our standard price of $6.40. Okay, when we multiply all that out, we get 6,400. Okay, so we need to know whether or not this 6,400 is a favorable or an unfavorable. And we can know that it's unfavorable. Okay, so we're going to write that next to it. Again, mathematically, it is a positive number. These are all dollars, by the way. Mathematically, this is a positive number, so we know it's an unfavorable. Logically, our actual quantity was 1,000 more than what we had budgeted. Okay, and then the last one, our direct materials cost variance. We're going to take our direct materials price variance, which is up here, plus our direct materials quantity variance, which is right here. So we're just going to pull these numbers from our equations above. 10,100 plus 6,400, and we're going to get 16,500. Again, this is dollars, and this is unfavorable. Okay, two unfavorable numbers obviously give us an unfavorable logically, and mathematically it's still a positive number. Okay. We're going to follow the very similar pattern when we do our direct labor. So if we scoot down our piece of paper, it tells us that it's looking for the direct labor rate variance, and the equation is the actual rate per hour minus the standard rate per hour times the actual hours. Okay, so the first two are rates, the last one is the hours. So if we look at our second line, covers our direct labor, our standard, and our actual. So we need our actual rate per hour was $15.40. Our standard rate per hour was $15.75, and our actual hours was 2,000. So we're going to take those numbers, plug them in here. Actual rate per hour was $15.40, minus our standard rate per hour was $15.75, times the actual hours we used, which was 2,000. We multiply all of that out, and we're going to get a negative 700. Again, this is dollars. Yeah, I'm not sure if that dollar sign goes outside the parentheses or inside. Let me look. Oh, it goes outside. You learn something new every day. So again, your dollar sign goes outside the parentheses. This is a favorable variance. Again, how do we know the difference? It is a negative number, so that's what makes it favorable. And if we look logically, we had budgeted $15.75 per hour. We only paid them $15.40 per hour. So logically, it's favorable because we paid them less. Favorable for us as a business, I should say. Okay. The next one, we're going to look for the direct labor time variance. So the actual hours minus the standard hours times the standard rate per hour. Okay, the actual hours minus standard hours times the standard rate. So our actual hours, if we look at our textbook, was 2,000. We had budgeted 2,080, and our standard rate was $15.75. So our actual direct labor hours was 2,000. Minus our standard labor hours, which was 2,080, and we multiply that times our standard rate of $15.75. When we do the math, we get 1,260. And again, this is a favorable variance. Mathematically, it's a negative number, so it tells us that we spent less money. Logically, it tells us that we only used 2,000 hours and we had budgeted for 2,080 hours. So our total direct labor cost variance, we're going to take our direct labor rate variance plus our direct labor time variance. So we're going to take that negative 700 plus the negative 1,260. And when we do that, we get negative 1,960, which again is still favorable. If you have two favorables, you're going to get a favorable, okay, because it's still a negative number. We still spent less money than we had budgeted. Okay, that's what that negative number means. It means we've spent less. Okay. Now the next one is going to be a little bit different. We're going to be doing our factory overhead cost variance. This one is a little more in-depth than the other two, a little different mathematically. Okay. The first thing we have to figure out is our variable factory overhead controllable variance, and that's a mouthful. But it is our variable factory overhead controllable variance. And I made these boxes a little big so you can try to get it all to fit in one spot. Okay, put a colon there. Variable factory overhead controllable variance. So these are things that we can control, things that we have the ability to change. So the first thing we're going to look for, we're going to indent this one a little bit. We're looking for the actual variable factory overhead cost incurred. So again, the actual variable overhead cost incurred. We want to know how much variable overhead did we actually incur. Okay. And if we look at our textbook, it talks about our overhead, okay? Factory overhead rates per direct labor hour based on 100% of normal capacity of 2,000. It tells us what our variable costs were $4, and our variable costs, it would have been $4 per hour. Our variable cost came out to be 8,200. Okay, so our actual cost in our actual cost column, it tells us 8,200. So that's what's going to go over here in our report. We need to know what our budgeted variable factory overhead for our 2,080 hours were. Whoops. Okay, our budgeted variable factory overhead for our 2,080 hours, because we went over that 2,000 hours. So our textbook tells us that standard costs, our standard variable cost was $4 per hour. So we're going to take that 2,080, and I'm just going to use the edge of my paper here, times the $4. Okay, and I get 8,320. So that's what's going to go here. Now we're going to subtract these two numbers. When we do that, we get a negative 120. Now we know by a negative number, that means we spent less than we had planned. Our actual was less than our budgeted. So we know this is a favorable number. So our title for this one is going to say Variance Favorable. Okay, so this was our variable factory overhead. Now we're going to look at our fixed factory overhead. So we're going to start back out to the left. Fixed factory overhead, volume variances. Oops. Again, little colon. And we're going to indent. So if we had a normal capacity at 100%, we want to know what our normal capacity at 100% was. So if we look at our textbook, it tells us that based on 100% of normal capacity of 2,000 direct labor hours. Okay, so 2,000 is our number we're looking at. At a normal 100% labor, 100% normal capacity, we're looking at 2,000 hours. Now, the next thing we're going to put in here was our standard for the amount produced. And we know that that number is 2,080. Okay, because our textbook told us that. Our textbook told us up here under our direct labor that we used 2,080. Okay. So again, we're going to take these two numbers and we're going to subtract them. And we're going to get negative 80. And this tells us how many hours. This doesn't tell us in money. Okay. We're up here are 120. This was in money. This was in dollars. This is in hours. Now we can't add hours and dollars. It doesn't work that way. So we have to be able to turn this into dollars. First, we need to label this. This gives us our productive capacity overemployed. In other words, what we used over what we should have. So we have this 80 hours, and again, we cannot add hours plus dollars, so we have to turn this into dollars. So if we look at our textbook, it tells us that our fixed cost was $6. So if I come down here, I'm going to put in $6, and this is going to be my standard fixed factory overhead cost rate. Okay, so now I'm going to take this 80 hours, negative 80 hours, and I'm going to multiply it times that 6. And I'm going to get negative 480. And again, this tells me my dollars. This also tells me this is my variance. This is how much money I saved. okay, because it's a negative. So I'm going to write in here, and we said negative saving money is what we want, so this is a favorable. And just like we do with direct materials and direct labor, I'm going to take these two and add them together. So I have my variable factory overhead is at negative 120. My fixed factory overhead is at negative 480. And if I add those together, I'm going to get negative 600. So total for our factory overhead, we saved 600. Okay, so I'm going to put right here total factory overhead cost variance, and of course it's favorable. Okay, so again, this one's a little different than the other one, than the other two, but it still gives you the same outcome. It tells you your variable at the top, your fixed at the bottom, and then the total. Okay, if you need to return to your PowerPoint to finish that, please go ahead. Otherwise, you can move on to your assignments. Have a great week.